Welcome to the Ellsworth Advisors monthly update for July 2026. I'm Kelly Keenan. This is Cameron Mealy, and today we will review what happened in the markets in July, how our portfolios performed, also review some of the latest economic numbers, and give our thoughts on what we see moving forward. Cameron, why don't you kick it off with with the latest economic research?
Perfect, will do. Thank you, Kelly. Hope everyone is well out there. By reference, today is Tuesday, August 4th. Some of the economic news that we've seen, not really economic news, but the U.S. and Tehran are currently in negotiations to once again end hostilities in the Middle East and open up the Straits of Hormuz. Hopefully that is successful. We've seen hostilities, negotiations. Oil has fluctuated. The market doesn't like uncertainty, and there's a lot of uncertainty here. Most of it around the energy complex, but hopefully we get a favorable resolution and we can put this behind us. Energy obviously has caused some of the heightened inflation we've seen over the last several months. We'll get into the numbers, but we have seen inflation appearing to come back down a little bit to more normalized levels. That has allowed the Fed maybe a little bit more flexibility. So we just came off of a 2-day Fed policy meeting, and the Fed announced that they're keeping, on a 9-3 vote, they're keeping their Fed funds target rate stable at 3.5 to 3.75%. But the Fed has said that they're going to continue to monitor the information, and if they see inflation is still heavy, they are prepared to implement some interest rates increases. Right now, the market is looking at about a 65% probability that there could be a 25 basis point increase either in the September meeting or the December meeting. So I think we all assume that inflation would be coming down. We've had these disruptions in the energy complex, which have led to heightened inflation. It has mediated, but it's not where it needs to be. I think this is going to be something that we're probably going to be talking about for a while.
Yeah, definitely what's going on with the Fed, and it's all around inflation right now. We're nowhere near the 2% target. How much the crisis in the Middle East, war in the Middle East with higher oil prices, how much that contributes to the higher inflation numbers, it obviously does. But even stripping out food and energy, the numbers are still on the high side. The question is, well, should the Fed raise rates to try and slow down the economy to bring down inflation? That's what the debate is about at this point in time. And once again, if things do settle down in the Middle East, you get rid of the energy pressure to the upside, cost pressure to the upside. What does that do to the overall inflation numbers? That's kind of what the Fed's waiting to see. To see what happens.
And really, energy is a tipping point for the global economy, because energy goes into shipping costs affect food, the manufactured products. I mean, everything really comes from energy. When you have heightened energy, it's going to flow through cost of goods sold and always going to be punitive. It is interesting because we're seeing a lot of divergence in numbers. Inflation's high, the economy appears to be cooling, but if you look at now some of the new economic projections, they look strong. So this is kind of the problem with looking at economic information in a vacuum. Every month we come up here, we tell you what happened, and sometimes it looks like we need to take immediate action because inflation is running too hot, or we need to take immediate action because GDP is coming down, and you give it another month and all of a sudden the information changes. So the Fed, with the access to information we have today, the constant economic news, the Fed really does have a lot of pressure. They've got to play the game almost perfectly, and that is nearly impossible.
Right. So we'll see what plays out. I would argue the less they do, the better. The economy's in pretty good. We're on sound footing economically. We are showing positive GDP growth, which, why don't you jump into the
let's run through the numbers. So GDP on July 30th, the Bureau of Economic Analysis reported that according to its advanced estimate, GDP in the second quarter increased at an annualized rate of 1.5%. You'll remember in the first quarter, GDP increased at an annualized rate of 2.1%. So obviously, GDP has pulled back a little bit, but this is the advanced estimate. It will be revised. If we turn to projecting the third quarter, as of August 3rd, yesterday, the Atlanta Fed's GDP Now forecast model is predicting third quarter GDP will increase at an annualized rate of 6.2%. Obviously, that is a blowout number. We expect that to come down. That number does move again as information is released. The Atlanta Fed updates their model, and we can see significant spikes. Current Wall Street consensus is still around 2 to 2.5%. So I expect that GDP forecast to come down. There's nothing in that more than it. That is strict math. And when a hot number comes in, it raises everything. So I do expect that to come down. So the economy, as Kelly said, is on pretty good footing. We'll get into jobs. Unemployment remains historically low. And let's talk about inflation, which is kind of the sticky wicket right now. The Producer Price Index. On July 15th, the Bureau of Labor Statistics reported the Producer Price Index decreased 0.3% in June. On a year-over-year basis, the index is up 5.5%. The 0.3% decline in June is the largest decline in 14 months. Good news. Obviously, the annual rate running at 5.5% is double the Fed's, more than double the Fed's inflation expectations, so that is a troubling number. Personal Consumption Expenditure Index. On July 30th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Expenditure Index decreased 0.1% in June. For the 12 months ending June, the index is up 3.7%. Still hot number for 12 months. Consumer Price Index. On July 14th, the Bureau of Labor Statistics reported that the Consumer Price Index decreased 0.4% in June. This is the largest monthly decline in CPI since April of 2020, but yet again on a year-over-year basis, CPI is running at 3.5%. So it does appear near term, things are coming down, but based on historical inflation, the numbers are still elevated. So that's why the Fed is in a tough decision. I think standing pat until we really see a trend is probably where they're going to err on.
Absolutely.
Last thing to talk about, July. On this Friday, August 7th, we will have the jobs report for July. But on July 28th, ADP reported that for the 4 weeks ending July 11th, employers added 15,000 jobs per week. This would be consistent with June's job report showing the U.S. added 57,000 jobs. So 15,000 a week, we'd be at around the 60,000 level in July, and that would keep the unemployment rate at 4.2%. So the employment picture looks good. The inflation numbers seem to be coming down. First quarter GDP was good. Second quarter GDP appears to be a little weak. So again, I just think we're in this situation where it's kind of wait and see.
GDP a little weak, but still positive, and then
And meanwhile, the market is
forecasting 6% for third quarter, and we're not nobody's forecasting negative GDP. So the growth is definitely still out there. And as we start looking at the market numbers, a lot of divergence. So Cameron talked about the war a little bit, things going on with the Fed. We have inflation numbers that seem hot, plus you get a new Fed chair in there. So what is the Fed going to do? A lot of headline noise, a lot of headline narratives, but underlying everything is a fairly solid economy, good employment numbers, GDP growth, and oh, by the way, earnings have come in very well for second quarter. So, basically companies are still making money. And what we have seen in the market is a lot more participation. The last several years have been really, the market's been driven by a handful of names. Those names that were doing so strong aren't so strong now, but the rest of the market is doing a lot better. When we talk about the markets themselves, we had a strong June. July, and the S&P was only up 0.14. The NASDAQ down 1.76. So a lot of those big name tech stocks definitely struggled in July. The Dow Jones down 0.73. So flat to slightly negative there for the Dow Jones. Small cap stocks, which had been doing very strong, once again had a little bit of a pullback in July, down 2.12. International stocks, the MSCI EAFE up 1.06, and then emerging market stocks down 0.9. Once again, they've been pretty strong year to date. Market-wise year to date, the S&P still up 10.14. NASDAQ, even after a bad month, up 9.53. The Dow Jones up 10.17. So the domestic, large cap Dow still leading the pack. Small caps, measured by the Russell 2000, up 18.85. International stocks still up by 12%. Emerging market stocks up 20.27. So year-to-date stock market strong. What I didn't mention previously for the month was the bond market. The U.S. aggregate bond market year-to-date is now down 0.69%. That's after a negative 1.17% for July. And that is a result of interest rates kind of going up a little bit. We're not talking about massive moves, but rates are higher. That brings bond prices down. For us, for our portfolios, we're focused on the short term. We're getting that 4 to 5% range from our coupon standpoint. Because we're short term, we're not feeling that negative effect. So our bond positions are holding in there really well. When you look at our stock portfolios, our appreciation with income portfolio for the month was up 2.5%. Year to date, we're up 14.5%. Big gainers in July: Microsoft up 19%, Hewlett Packard up 16%, EOG Resources up 14%, Huntington Ingalls Industries up 12%. Laggards during the month: Dick's Sporting Goods down 17%, Lamb Research down 16%, Eli Lilly down 15%. Year to date, though, even though Lamb Research down 16%, year to date Lamb Research up 71%, EOG Resource up 42%, CVS up 32%. Year to date, Meta's down 16%, Microsoft down 4%. So kind of a mixed bag, but more good than bad in there, obviously being up 14.5% year to date. Our dividend yield in July, we were kind of lagging in here, or it's kind of been a slow mover, but July we were up 2%. Year to date, we're up 16%. Big gainers in July: Chevron up 16%, Bristol Myers up 12%, Western Midstream up 7%. So a little more action a little more uncertainty in the Middle East. Energy, stocks have been up, for the month. Laggards: American Electric Power down 8%, Altria Group down 6%, Consolidated Edison down 5%. Gainers year to date: Cisco up 50%, Chevron up 29%, Public Storage up 25%, Johnson & Johnson up 24%. Laggards year to date: Medtronic down 11%, Pepsi down 3%. In our growth with income portfolio, for the month up 1.5%, year to date up 8.5%. Gainers in July: Nucor up 17%, EOG up 14%, Exxon up 13%, Digital Realty Trust up 9%. Laggards: Caterpillar down 15%, Microchip down 12%, Lennar down 7%, Nike down 5%. Caterpillar, just by the way, a lot of that's being made up today. Year to date, Nucor still up 58%, Caterpillar up 42% year to date, EOG up 42%. Our ETF for commodities up 30%, ExxonMobil up 29%. Laggards: Nike still hurting us, down 35%, Lennar down 20%, Disney down 15%, Toyota down 12%. Our price potential portfolio, another good month here. We've been, basically knocked the ball, the cover off the ball. 3% up in July. Year to date up 40%. Gainers: BP, British Petroleum up 21% in July. Petrobras Brazil up 20%. Microsoft up 19%. Arista Networks up 13%, which we just exited, and Amazon up 12%. Laggards: AMD down 8%, Meta down 4%. We had Marvell, which was down 40%. We sold that off, and Sam Neiman was also down 15%, which we sold, but we did lock in a 34% gain. Year to date, big winners: Dell up 222%, Advanced Micro up 122%, Petro Brazil up 64%, Technip FMC up 61% for the year. Then our laggards year to date: Meta down 16%, Microsoft down 4%. So you'll see, even within tech, it's not everybody's moving the same direction.
Yeah.
It's been a lot of divergence. And the reality is we're not buying sectors. We're not buying, just large cap, small cap, mid cap. We're buying individual companies.
Based on their individual fundamentals.
And I think that's definitely why we've been outperforming so far this year. In our small cap arena, our SMID portfolio, as we talked about, the Russell 2000 was down last month. We did take a little step back in July. We were down 3%. We did have some gainers though. V2X up 22%, Calumet up 21%, Navigator Holdings up 17%, Spire Therapeutics up 14%, First Source Corp up 9%. Laggards though: Easy Corp down 16%, Mirum Pharmaceuticals down 16%, BrightSpring Health Services down 14%, Kinetics or cytokinetics down 11%. Year-to-date, Spire still up 200%. NWPX infrastructure up 97% year-to-date. Gorman-Rupp up 70% year-to-date. Bright Spring Health Systems up 59%. Park Aerospace up 59%. Year-to-date laggards that we still have in the portfolio, the only thing that's down is Inramed Corp down 7%. So, it's been a good year for our small caps. Just they're always gonna be volatile. So a rough July. So in general, our portfolios are working.
Yeah. I mean, I think the biggest thing to remember is we still expect to have positive gains in 2026. It's looking like, 10+% returns are possible. We do have midterm elections. We've got primaries coming every day. The midterm elections are probably going to be pretty ugly. There's going to be a lot of discussion around them. So expect some volatility. But, as Kelly said, employment's strong. The economy is strong. Corporate earnings are good. This inflation thing has to come under control. But the Middle East conflict certainly is one of the causes of the heightened inflation. So if we can see that come down, we're generally in a good position.
Yeah, we're not buying the whole market. We've been selective. Being selective is working well. It generally always does work well. Fundamentals matter. And I've been talking about this in my write-ups and everything. Yeah, volatility. We're seeing it. By the end of the month, things kind of cool out, but it's on a week-to-week, day-to-day basis. We're seeing a lot of swings in the market itself. And it's not going to calm down until we get through the election.
Yeah.
So I think more of the same, get through the election.
This is one of those periods where Dow up 500 one day, Dow down 700 the next day is probably the norm for a little bit.
Yeah, and you know what? That's fine because the fundamentals are sound, but you're just going to have a lot of headline noise, and we'll probably be talking about some of the same stuff again next month, I have a feeling.
But if the volatility...
that's all right.
Yeah, if the volatility, causes you angst, my recommendation is you don't need to look at your account every day. Your money's not going anywhere. We're the stewards. We're minding it. Check your portfolios quarterly. Check them monthly, but you don't need to check them every day. We're on top of it. If you have any questions, please feel free to reach out to us. Looking forward to a great August. Hope you have a great August, and we'll talk to you next month. Thank you, as always, for the trust you put in us at Ellsworth Advisors.
Thank you.